Ladies and gentlemen, good day and welcome to the HDFC Bank conference call hosted by CLSA. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Adarsh Parasrampuria from CLSA. Thank you, and over to you, sir.
Hi, good morning, good afternoon, good evening to participants who've joined the call. On behalf of CLSA, I would extend a very warm welcome to all participants for the HDFC Bank Group Investor Call hosted by CLSA. Today from the senior management team of HDFC Bank, we have Mr. Srinivasan Vaidyanathan, the CFO, and Mr. Ajit Shetty, the Head of Investor Relations. Without taking too much time, I would like to hand it over to Srini for his opening comments, and then we'll open up the session for Q&A. Over to you, Srini.
Okay, thank you, Adarsh and the team in CLSA for this opportunity. I appreciate the time here. All the participants, welcome, and we hope to have a good conversation as we go along. Let me kick it off. There are 2-3 things, perhaps, Adarsh, if you're okay, we start with the introduction. One is perhaps I give an overview of the macro as it stands now and as we see it. We can talk about the transition and how things are panning out in the last month or two from that sense. We can briefly touch upon the strategies which is part of the transition in terms of what is it and how that is going and in terms of the focus, specific areas of focus. Then we can talk about the quarter P&L, very, very high, maybe a minute or two, very high overview of certain key line items that we can talk. And then I'll give it back to you to see what. So these are the 4 or 5 things that we will cover, right? Starting off with the macro, which is very topical as we stand now. The pickup in the economic activities of the indicators that we see is being quite sharp than what was earlier anticipated, right? One is the support of the festive season demand. You know that in India, October, November, this year, October, November, is the peak of the festive, and that has aided some of these kind of more than anticipated demand. The indicators are looking good. And also the unlocking of the economy. It coincided with the unlocking of the economy for most part. Very, very selective places where there is a tremendous amount of concern. There is some small lockdowns, but otherwise predominantly the unlocking has happened, right, from that sense. The PMI, as one of the indicators, right, at 58.9 is quite good, right? Anything above 50, is an expansion. The recent reading at 58.9 is pretty good from that sense. The power consumption is a double digit, which indicates that double-digit growth in power consumption. That indicates quite a hectic activity happening in various parts of the country, right, from that sense. GST collections, which is the indirect tax collections, value-added tax type one, but GST collections at about 1 trillion Indian rupees mark, right, for the first time this year in October, right? So if you think about January to October is the highest, and it crossed 1 trillion Indian rupees. So from that sense, you can see the activity picking up, and thereby the collections on the GST taxes as it is levied phenomenally showing great kind of an increase and growth there, right? Which we have seen, and even during the quarter also we mentioned about the quarter end call also we mentioned about the car sales, the two-wheeler sales, quite a healthy double digit, right? Sometime in August it was about in teens, 14 or something. September was in the 20s from a growth point of view. And those kind of buoyancy, both urban and rural, right? Rural demand. In the rural, it's more tractor and motorcycle and the small car type of sales. And then in urban, the other things in terms of the passenger cars, the bigger cars and so on. Quite a record in terms of the positive performance that we see. And then the last thing on the activity pickup I want to say, the silver lining for all of this is also the Kharif output, the agri Kharif output very healthy output, and the sowing season was fantastic. And the next harvest season is going to begin soon, in a month or month and a half. It is going to begin soon. So from that sense, the rural economy, which was far removed from virus, right? So in that sense, I would not say zero, but far removed. That means very, very small impact in the rural economy, came relatively unscathed and very, very, very insulated from that sense, did well from that sense. So that's in terms of the activity pickup that you're seeing, getting a sense of where we stand now from that sense. Growth, if you have to talk about what does this translate into a growth, right? All of those indicators, a few of those that I said, are contributing to the output, right? In terms of how the high frequency indicators giving, or it shows that the growth is durable. At least some of these indicates that the hope or the growth that we are seeing will be durable, and it's not something which is a pent-up demand that is coming, or only the festive season. Some of these indicators show that the momentum in that high frequency indicators show that it is durable from that sense, right? The rural, of course, is doing better than urban, so all of that is fine. From a GDP point of view, our house estimate is that Q3 would be positive. Q3 is the time period October to December is positive. Q2, which will be published any time now, has got a negative estimate. It's in low double-digit negative estimate, minus 11% or something like that. If you remember, the Q1, April to June, was minus 24%, right? So from that sense, things are rapidly coming, and our estimate is close to 0.5%. It's positive in Q3, and our house estimate for Q4 is about 1.5%. So from that sense, we are seeing that things have touched the bottom and it's going up, and the full year, consequently, the full year GDP is expected to be about minus 8 and change, right? 8.3% or something like that. That's what we expect the full year GDP, full year 21, financial year 21, which is March ending, right, for us. We expect about minus 8 and change. And then thereby, if you think about one more year out, our house estimate is also anywhere, it could touch double digit in FY22. That means March 22, year ending March 22, the GDP growth could touch double digit. 9-10% kind of number is quite possible from our economist viewpoint as we stand now, right? And we look at it. Now, these are not, there are some concerns that are being addressed too. For example, the inflation worries, right, are being addressed. With the declining growth in first half of this year, which is the April to September time period, the inflation pressures did continue to mount, right? Due to we believe mostly due to the supply disruptions. That is what has caused this, right? Because when the economy is not growing, the pricing power cannot be there, right? You don't expect a pricing power when there is not much of a growth. But you do see inflation, which we believe is due to the supply disruptions. That is what has caused that, right? When you look at it, it's not been restricted only to the vegetable price hikes or something which are perishable, coming from rural, moving to urban, transportation restrictions due to lockdown, etc., but there are several reasons one could attribute to. But it's not just those vegetables, it's broad-based, what we call the protein basket, right, which is a major component of the food grain thing. There also we have seen increase, right, in inflation. That is also part of it. The core inflation, excluding food and fuel, also remains sticky, right? The signaling there is some pricing power in the system. Still there is, you would expect there is no pricing power, but there is a pricing power in the system. That's what it indicates, because the core inflation also remains stubborn and sticky up, right? So that is, it's showing that. And so what we believe is that there will be a floor on the headline inflation, even as the vegetable prices cool off, the pulses, the protein basket prices cool off as the supply disruptions normalize. We still expect that inflation could remain sticky and there may be a floor. Well, it will come down, but it will not come down below a few. We expect maybe it will be about 6.5 or slightly above, 6.5% or slightly above in November, compared to maybe 7.5% in October, right? So it's coming down, but still at a high. And maybe in Q4, our house expectation is that it will settle 5 to 5.5, and that's where it will be on an average, even for the financial year March ending 22, also 5.5 kind of range is what we expect, right? That's in terms of worry, in terms of inflation and how we are worrying about that. Then what does it do to the monetary policy outlook, right? From here, if you think about what is happening in that sense, it's been quite an accommodative policy from the central bank in terms of making huge amounts of liquidity available in the market. So from that sense, we expect there may be a policy rate change anywhere from 25 to 40 basis points. I'm not sure possibility is there in the first half. There is a policy meeting in February. There is a policy meeting in April, 3 months down the line and 5 months, 6 months down the line. There is a policy meeting. We expect there is a possibility that there can be 25 to 40 basis points change there, right? And if inflation cools off in the coming months, so that is a big if. If inflation is cooling off, there is a possibility. Otherwise, maybe there is nothing there, right? From that sense. However, what RBI has done is in addition to the policy rates, they also manage through yield management, which is they have done what we call the open market operations to bring down the yield curve twist, which is bringing down because the lower end is a policy, the higher end is market driven. So if they do twist, operation twist, as a few times the Reserve Bank has come and done, tried to bring the curve down, right? So that has happened, and we believe it will continue to happen from that sense. And what does it do? It keeps the borrowing costs for corporates at the lower end of the range, right? It keeps them pretty low from that sense. The corporates tend to benefit from that, right? And our house view is that the 10-year yield could be 5.8, 5.95 in that range in the near term. But it remains to be seen what happens after the inflation and the policy rates in February and April. Now, that takes us to a view on the credit and deposit growth, right, in the economy. What is the credit has grown at a very moderate pace, 5.1% or so as of October, right? And the deposit continues to grow at about 10.1% to be more precise, year-on-year kind of growth, right? It's a mixed bag in terms of the segments in which micro and small enterprises, not much growth, right? When you look at month over month or something, slightly better, right? September is better than June. That we have told even in our own book, we have seen and we have said, and in the economy also it is very similar from that sense. And some of the medium enterprises, 14.5% or so. Retail credit growth, 9% something, moderating from 10% in August. So some of those are showing some kind of a robustness in terms of growth. The way we look forward is that, right, from an economy point of view, in the second half of this year, which is October to March time period, 5 to 6% credit growth is what we expect the market will have. And again, due to various support from the government, including the guarantee scheme support, as well as the RBI accommodative stance, all of this helps in terms of maintaining 5 to 6% growth, which we expect in the second half. On the deposit, we expect continuation of this, some modest kind of deposit growth, which is about 10% or so. We expect it will continue because it's about the individuals, households doing savings at this time. We believe that might continue. So that's in terms of the macro I wanted to cover, right? So you get a context of where we are operating and how things are shaping as we speak in the economy. Now, in this backdrop, if you think about what is going on internally, we did have the transition smoothly take place in late October, 26th, 27th October to be precise. The new CEO took charge. Sashi got into the position and has held a series of meetings as part of the transition. It has been pretty smooth, both internal and external. Has had a series of meetings with the senior leadership in the bank, going through each one in terms of what they are doing and how they are doing, and which is been very, very conversant, not new, 20, 25 years in the bank. So from that sense is not new, but still as a CEO going through to say that shows the care for the people at large. And then having conversations with the customers too, key customers, corporate customers, SME customers. So having a full calendar in terms of going around and talking to them, not physically, virtual meetings all the time, right? So because that's what is the order of the day, going through that. So smooth transition from that sense. That takes us to think if all of this is fine in terms of the strategy. What is the new thinking of the new management, new leadership? Is there anything different from a strategy that you want to think and talk about? No. We have always articulated maybe 2-3 years now the 5 pillars of our strategy. They remain the 5 pillars. And if anything, what Shashi has done over the last 2 odd years is, as a change agent, traveled along the countryside with Mr. Puri to get the ringside view of everything that is happening from a customer point of view, from an employee point of view, from a communication to various people, the last person touching the customer, let it be the teller or the relationship manager or whoever, whether these pillars of the strategy are appropriately communicated, understood, and getting executed. That's what he's been focused on for the last couple of years. And there's no change in any of those. So we continue with all of those 5 because they continue to provide under any circumstances great deal of opportunity for growth, right? So we continue with those kind of strategy. Then what is the changes? What is the flavor, right? The strategies continue, but there is from a flavor point of view, I would say that what COVID has done from giving some more flavor to this strategy is making the digital 2.0 is one of the pillars of the strategy. Now the digital as one of the pillars is all pervasive across other kind of strategies too. Let it be the branch or the VRM or the payment. Across all of those strategies, the digital 2.0 takes in the center stage. Why? Because that's, if you think about the branch, I'll tell you what happened even in the last 6 months. Where as soon as the COVID hit, within 2 weeks, we rolled out what we call the Insta account. We do have a digital account. People can open digitally through the digital account opening process. But there were some handoffs, right? There will be some fall-offs that will happen. Somebody will pick it up and stitch it and take it forward. And then there may be a few steps that it has to go through before an account is consummated as done and to be operative. Now, with the COVID and with the restrictions on people meeting and doing various things, we had to stitch it in 2 weeks' time. Wherever there were process engineering required and where some handoffs were needed to be stitched up, we did it and we called it Insta straight through account opening, right? Which we did. And then towards the end of that quarter and then towards the second quarter, we also brought in video KYC. So you need to do the KYC process on a person. The Reserve Bank also helped in the process of bringing in a circular allowing the video KYC to be functional. And so we got that up and running. So all of this helped, right, in terms of, I think we described that 1.8 million new customer liability relationships that were formed in quarter 2, 1.2 million in quarter 1, right? And all of last year, for just as a reference point, 6.5 million customer relationships. So we pretty much, COVID or no COVID, we operated in a manner in terms of bringing the customer relationship enabled through these kind of a digital flavor that we superimposed across all of these strategies and we try to get through. And then as we go along, I'm sure we'll talk about the other flavors of digital, let it be the healthcare ecosystem or the payment ecosystem, the semi-urban and rural digital ecosystem and so on, and the auto-first digitization that we talked about even in the quarter end call. As we go along, if there is more details or interest, we can talk about those. But those are kind of what I would say as important elements that were coming in, some of them in place, some of them coming in place, and the flavor that gets added to those digital strategy. Briefly, a minute or two on the P&L. I think it's the old news. You all know the numbers. I'm not going through those numbers. You saw the net interest margin. You saw with the operating within the range that we have indicated, the revenue growth of the pre-provision and we managed the expenses to be in line with what we could afford. And although the efficiency, the operating efficiency or the cost to income improved a lot, we will not operate at that level, we said, because as the originations were low, some of the costs, the variable costs were down. but as we go back up in terms of increased activity, it will go back up 38, 39, and then over a medium term, longer term, we will continue to push that down as we go along, right? And credit costs or the NPA ratio, we have reported numbers were stable, 1.36, 1.37 in terms of the pro forma NPA, or the loss ratios at 1.41 compared to 1.51 last quarter. Again, pretty much within the ranges that we have been talking about in the past. And the ROA or ROE at 1.9 to 2 kind of percentage is what we have reported, which is also in line with, consistent with what in the past quarters that we have done, right? So that's in terms of the nutshell, to give you some opening remarks of where we stood and where we have come. Adesh?
Yeah. So thank you, Srini. You can just make the announcement for starting the Q&A and then, please.
Mm-hmm.
Sure, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask questions, please press star, then 1.
Yeah. Shri, during the time the question queue builds up, I had a couple of questions and I'll just start off. I think this would be, in my view, the top question people would have is, when COVID started off, and obviously it is a very large pandemic with a very large lockdown that we had. And the retail asset quality cycle has been fairly benign, right from 2011 and 12. And as we get out and unlock in the first 2 months, the outcomes, while we cannot conclude, it still looks way better than what, I think many managements had expected and obviously what investors had expected, right? So what, in your view, are the structural, elements that are driving this, right? Because, clearly it's been as of now, it looks like it would be a positive surprise versus initial expectations.
Mm-hmm. See, there are a few things to think about, right? What is driving the robustness? One is, for us, I will tell you, and then I think the industry is pretty similar too, which is, as we were entering the COVID, call it the December timeframe, leading into February timeframe, right? If you think about some of those, or even if you go to September, December, and then February, that kind of a trend, if you look at, which is pre-COVID I'm talking about, all of these metrics were improving a lot. For us, for sure, and for the rest also, I believe, right? Some of these were expected, and we have been articulating too, that all the time that that we are showing improvement, we are showing robustness, and it seems to be quite stable and nice, right? We have been saying that. One is that. So keep that in the backdrop that as the COVID was hitting, it was not even stable. It was improving. That was the kind of a trajectory that it was when COVID struck. So that is one context. The second thing is also always one has to benchmark, or the expectation itself gets benchmarked to any previous crisis or previous kind of an experience in the bank or in the economy, right? What was that experience? Because that always colors things, right? And ever since that happened, the last big one, at least from a retail point of view, you can think about it around the global financial crisis type of time frame. Yeah, at that kind of a time frame, global financial crisis, there was no bureaus. But we do have bureaus now. For many years, we have been having bureaus. As we entered into COVID, it was not the bureaus were old, 2 years or 3 years or 4 years or 5 years, but several years we have had experience of the bureaus. And the past experience of such a crisis during the global financial crisis, there were no credit bureaus. So from that sense, you see that the bureaus have helped. I would say that the bureaus certainly have helped in this process. Then from a lending practices point of view, at least I'll talk about the private sector banks across us as well as the other private sector banks. There's a robustness in scorecards, right? Once you have bureaus, once you come out of a crisis, which is the global financial crisis, there's a learning. our database, at least our analytical database, is 20 years old as we speak now, right? We were one of the first in the year 2000 to start that data warehouse, to have the analytics platform and build a scorecard around it. And so we've had tremendous amount of experience from that sense. And so the lending practice and then the segmentation, right? That what does that do? That helps us to segment, that helps us to develop proxies, model things, test out. There's nothing that we as a bank have done without testing anything, right? We always test and then go into scale, which is how we have operated. And so from that sense, there was a lot of robustness that we could see from that sense. I would describe these are the 2-3 things that have helped us: the scoring model, the bureaus, the experience of the financial crisis that has tuned many things. And as we were entering into the COVID, we were actually on a strengthening kind of a situation. And in the April timeframe, we did try to recall, and for the first time, we actually gave some data too, which is our own book when we try to benchmark with the industry. Particularly think about the retail book, the unsecured retail book. If the industry through the bureau analysis showed us 100, right, or 1.0, call it 1.0 as a delinquency in the bureau, ours, depending on the product, was anywhere between 0.4 to 0.7, depending on the product. So we had positioned sweetly into the top segment. And then to that extent, how did we end up at that level? 0.4 to 0.7 was what the bureau is showing. And then we go and look at the scores of our customers versus the bureau customers. And when we look at our customers, the 750 and above score, we had at least clear 12 percentage points higher than the next bank, right? So from that sense, we've been picking up customers of the high order from that sense. So these are some of the things that I would say that has put us into good stead from that sense.
Perfect. And just the second question I'll squeeze in and then start taking participant questions is one question on strategy. You've been adding 6 million customers over the last couple of years, and a part of the strategy is to target the top 20-25% customer of semi-urban markets, right? In the urban markets over the last 7-8 years, the strategy has been to kind of cross-sell asset products to, fairly strong salaried liability base that you have. How does that approach change in the when you target the next set of customers in the semi-urban markets, right, or the rural markets? What really changes, or the same strategy that continues in those markets?
In a nutshell, in a sentence, it doesn't change. But then in detail, what happens is that if you go to the genesis of the semi-urban and rural strategy, the genesis of that is semi-urban and rural is one of the fastest growing. And from a fiscal spending point of view, government spending point of view, is enormously focused on that. The rate of growth of government spending in semi-urban and rural is in the teens, is in a good teens, high teens, right? That's the growth of spending, the increased spending that they have in that area. So there's tremendous amount of focus that's happening in that front. So that is one. The second thing in that is the GDP of the semi-urban and rural now is at a level that urban was 5-7 years ago. So we are now seeing that it is entering into the sweet spot that where we took off in the urban 7-8 years ago. Now the semi-urban and rural is getting into that kind of mold on that sense. And we want to focus only on the top 20-25%. And then the demographic or the kind of market situation in the semi-urban and rural is there is no private sector bank competition. So we are first movers, early movers into that. So it offered that once we put that as a strategy and start to move there, we are the first and the biggest sitting there. So from that sense, it made us go for it, right? And then from a deposit point of view, public sector banks are the only ones operating, and their biggest product is deposit product. There is no loan product of any worth into that market. So that is why the credit to deposit ratio, the overall for the country is about 77%, right? Credit to deposit. 100 deposit, 77 credit. That is in the overall country. But in the semi-urban and rural, it is anywhere from 35% to 60%. So that means huge pockets of liquidity with very less credit penetration into those markets, right? So that what we did is that as part of that strategy, we said we have tried and tested products, full suites of products that we have, call it from a vehicle loans to commercial vehicles or two-wheelers, agri to gold loans to personal loans to credit cards to anything we have, right? So now we are trying to say and tried and tested with good scorecards and segmented scorecards that we could target to any kind of a segment. And we said, take that score take that kind of an approach without diluting any of the credit standards. That means the same credit standards you apply to the top end of that segment in the semi-urban and rural and go. And the first thing is, of course, a liability relationship, right? If you think about it, we have about 53% of our branches sitting in semi-urban and rural. We already have about 12,000 agri loan salespeople. We also have about 15,000 of SLI, right, the microfinance salespeople we have. And we also have about 15,000 of branch salespeople, right, because 50% of the branches are there we have. Now we said we don't need to have kind of only agri, only microfinance kind of sales. Turn this into a multi-product sales force. So we started to train. This is even as part of the strategy. Even 2 years ago, we started to train people. So agri people are not just doing agri loans. When they go into a village to deal with an agri loan, they are meeting the farmer. They are meeting the surrounding people in the kind of village and in the town, and they are trying to get the other products, which is the savings product or the payment products. So opening up the current accounts to open them up for accepting our credit card and so on and so forth. So we try to get into full-fledged entire banking suite driven through the liability relationship. Then came the CSC. Then we said, okay, this is an enormous opportunity. We need to deliver in the semi-urban rural at a lower cost. We cannot be adding branches of the same size, sales force of the same kind of magnitude to address the customers. We need to do it in a much more elegant manner. So then came the CSC relationship where we signed up with 1 lakh CSCs. And out of this, as we speak now, we have about 12,000 of them as business facilitators. Business facilitators are nothing but they can do what a branch does. Essentially, the 12,000 branches we have opened up, right? So we have a line of sight to do 25, 30,000, at which time we will be the largest distribution in the country, even overtaking State Bank from that sense, from an ability for distribution. All of these 12,000 business facilitators can do what a branch does today, right? I'm talking about business correspondents. I apologize. I used the wrong terminology. Business correspondents can do what a branch does, right? Business facilitators are only lead generators. They will generate the lead, hand off to the branch. Business correspondents will complete it. What a branch does, they will do. They can complete it and get the transaction consummated. 12,000 of them we have converted the CSC to be the business correspondents. And the rest, that 1 lakh remains as only facilitators. And that again, where does that take, right? That takes us to open the Gram Panchayat and the ecosystem around the Gram Panchayat to open the accounts, which even during the recent few quarters, we've opened a little more than 6,000 accounts. Again, liability relationship. The farmers and the mandi, 1.5 odd lakh accounts. This is liability relationship accounts that we opened there. Salary accounts. Semi-urban rural absolutely has got enormous amount of government employees, salaried government employees, hospitals, educational institutions, all of the government servants in various government outfits which are there, right? All of them are, we are networking everywhere, and we are opening a tremendous amount of relationships into those kind of segments. Then the latest is also the CSC eGrameen. eGrameen is something similar to, call it a e-commerce opened up by the CSC e-commerce, and where they have these stores we will get the orders and distribute in the semi-urban rural. So we tied up with the eGrameen stores for payment and having a full sort of relationships around them. So these are some of those things that we are trying to do to ensure that in the semi-urban and rural area that we are able to win. And this is, there is, from a credit point of view, no dilution. Same, take the scorecard, implement it there, the segmented scorecard, implement it and do. And in order to do that, the first mover is, of course, the liability relationship, which is what we have operated in the urban area in the past. Similar kind of structure in terms of our approach there.
Sure. Thank you, Srini. And Stanford, you can open the floor, or you can just start taking investor questions, please.
Sure, sir. Thank you. We take the question from the line of Andrew Graham from Martin Currie Investment Management. Please go ahead.
Hello, can you hear me okay?
Yes, fine. Thank you.
Yeah.
Yes.
Great. Thanks. So Andrew Graham from Martin Currie in Edinburgh. Can I really ask you two broad questions, if I may? Then I'll drop off and rejoin the queue. The first question is more about loan growth and what excites you as being the best opportunities for loan growth over the next sort of 12 to 18 months, both in retail but also in business loans. I mean, I remember speaking to you guys a little while back when you were turning cautious on auto loans, and particularly auto dealer loans. So interested in your views on those areas now. And then the second question is more about your fee base and the potential for disruption or severe competition on fees. Where do you feel there are risks, and where do you think you're in a pretty safe place? So I'll stop there. Thank you.
Okay. No, thank you very much. We will talk about the loan growth, right? See, there are several chains we can think about in terms of how the loan growth. First to keep in mind is, in the country, the loan demand far outstrips the supply. So there's enormous demand for loan in the market. So that is something that is given. That is because of the completely underpenetrated from a loan point of view. If you think about the loan to GDP, one of the lowest, the runway is far open, long runway to go to come anywhere closer to Western world. Then one might say, why are you even benchmarking with the Western world? Even if you look at another emerging market, we have a long way to go from that sense, from a credit penetration into the population. So we have, and as we see today, the loan demand far outstrips the supply, right, from that sense. Then that is at a very macro level. Then if you come on to a little more detail, you see, the kind of innovation that happens is phenomenal. Think about, I want to give you one or two examples and then go into a little more detail from there. Even during this COVID period, there's a lot of what we call the simple Kirana stores, the small stores which are there, right? All people had to do to stimulate demand for them and stand out as a separate kind of a store, so that they can draw the customers and thereby get the bank lending. All they have to do is do some value-added services. Like what? Value-added services is simple. They have to have a delivery service. They need to have a refrigerator in their Kirana store, which is what people, entrepreneurial, self-employed, those kind of store people who went into these kind of things, even during the last 8 months of COVID time period, did phenomenally well, right? And there are several thousands of them where we are also targeting part of our ecosystem, bringing them in, both from a lending point of view and a relationship building point of view. And they are able to do businesses which is 2x than their other peers, right? So there are small type of innovations is enough for people to make a difference in the market. And then from our point of view, it is our ability to go micro, right? And because of our analytics, we do proxies all the time. We can do proxies. Bureau, of course, supports, but we can also use our own database to draw parallel. And we are pan-India, and we have digital platforms to deliver, and that's how we are trying to target the robustness in our growth, right? And the demand is picking up in the market. I told you about some of those examples of the demand, how we see from that sense. Let it be any type of loan, from two-wheeler to car to gold loan to loan against shares to all of those things are pretty well entrenched and quite nicely growing from that sense. We are also targeting these through some ecosystem development. It's a good opportunity to mention about the auto ecosystem, because you touched upon the dealer, and I will come to that particular thing, and also about the healthcare ecosystem. See, we are embarking. We have not implemented it. We are embarking, and we announced it in our earnings call too about the Auto First. Auto First is an ecosystem where we are developing a platform to bring together the auto manufacturers, the dealers, distributors, the service, the people who service the car or the vehicles, and then the customers, the end customers, from identification of what they want to doing the test drive to getting the car to doing the service, everything in one platform. We are trying to stitch it together to make it available. And we said maybe in 90 days time, we will have a broader announcement and an implementation around it. But that is something is what we are making a differentiation from that sense on the auto. The dealership that you alluded to a couple of years ago, we did have an isolated instance of dealer fraud, which we took a loss. I think that's what you're referring to. But then over the last 12 months or 18 months, where the auto demand has come down, we will of course cut the lines down as we go along, because once we see the inventory is dropping, sales are not happening, the financing, the open to buy, the lines that are open will be cut back and brought down, which is what we have done too, right? And then as we see things pick up, we pick up subsequently, we pick up the volumes and go. And we are seeing some of those robustness in the auto coming back to life. I gave you a couple of ratios in terms of the auto loan growth in August 14%, September 26%, and so on. So those are good indicators to see that the auto industry is turning around and touch the bottom perhaps and turning, right, from that sense. The health system, which we announced, is also a platform-based approach where we have existing relationship with the hospitals, with the nursing homes, with chemists, with the stockists and distributors, with pharmaceutical companies, and with the doctors, and we have a lot of consumers, 60 million of them we have. Now, with this healthcare ecosystem, we've done one, and we are trying to do with the rest of the big hospitals too, the Apollo Hospital. Apollo Hospital has got 20 to 30,000 doctors, some permanent doctors, some visiting doctors, 20 to 30,000 of them, right? And they have almost 300,000 customers, about 10% of them, 30 lakhs, call it 3 million, they are active. So that means the rest of them are not actively having a footfall into the hospital. 30 lakhs is having active footfall. The rest out of the 300,000 that I mentioned, 300 lakhs that I mentioned, they are registered in the hospital, right? So we are exposed to them in terms of relationships potential. Pharma, Apollo related pharma, 3,500 of them, right, that we have. And employees, 65,000 employees. So I'm giving you some of these numbers to say we're tied up with one of the players in that ecosystem to further our relationship across all of these in this ecosystem. And not only liability, all of this is also liability and the lending relationship across all of these segments. That's in terms of the healthcare. In terms of the payment ecosystem, this is signing up the merchants, right? Merchant signing up, processing of merchant, we have always said is not at all profitable, right? At best, it's a break even, a few basis points negative, few basis points positive, but take it as a break even from a merchant relationship point of view, because the merchant discount more or less is paid out as interchange, and there is nothing much on that. However, the whole banking relationship that comes with you having insight into the payment account, the current account that the merchant opens, the cash flows that you're able to see, gives rise to two things. One, it gives rise to the relationship of opening the employees and the promoters or the owners savings account and current accounts with us. So that gives you the liability relationships with them, and it also helps you to give a lending relationship with the merchants. And these are simple process, but then the ecosystem, what it does is that it tries to take it to bring some value-added services in the form of providing inventory management facilities through the application we deliver. They can do the inventory management. Also, it also helps to make a hyper-local offer, because any merchants that we sign, and because of our branch relationship and the other CSC ecosystem relationship that we have, we can do and we are doing hyper-local offers. They take a merchant, X thousand people around that merchant, we are making hyper-local offers to them, so that the merchant is able to draw our customers into the merchant establishment, bring the footfall in. And apart from, I'm talking about the digital, and here I'm talking about the physical in terms of how. So these are some of the things that I would say in terms of the retail how we are trying to focus and get that. And in terms of the wholesale loan, we have demonstrated over the last 4 quarters and certainly over the last 2 quarters that we've been a preferred lender to many of the top corporates, and we've kept up our credit choice and the risk appetite quite well, which is like 4.3 on an internal scale of 1 to 10, which is equivalent to about AA. Right, that's the kind of a profile of customers, and we've been preferred because of our digital approach to serving customers, from cash management to trade to FX to lending to all of them. Through the digital process, they can get these things delivered, and our liquidity strength and our capital strength. So the corporates know we are there to support them because we do have the basic ingredient, strength in the basic ingredient of liquidity and capital to continuously lend to them. As long as they are highly rated, we are there for them, right? So from that sense, we are taking care of that lending proposition from that sense. Then you touched upon the distribution from the third party, what is happening from that sense, right? Yes, certainly from a fintech point of view, there are players coming in, technologically savvy, but they are mostly addressing price-sensitive customers, right? Which is customers who prefer do-it-yourself style, right? So which means they get into the system, choose what they want, let it be the robo-advisor or self-select whatever they want, and they get the job done with hardly any fees perhaps, right? The ticket sizes typically tend to be smaller in those kind of scenarios, and the commissions are pretty low or non-existent. At the bank, however, right, our customer segment is very different. We are targeted to customer segments who have higher investable surplus from these product suites point of view, how we go and market them, right? And most of these customers seek much more information before making investment choices. It's not that they make a self-selected of they decide what to do. They have a discussion saying, this is what I want to do. And at the end of the day, the delivery that happens, once they make up their mind, even our own customers, high net worth, quite high ticket size customers, once it is done, they may go online, or we may guide them, assisted digital, to go online to get it executed so that we keep the cost low. So the point I'm trying to make is that whatever the competition, the fintech types that comes against all of these, the customer segment is pretty different than the customer segment that we are operating in. And we believe that market has got opportunities for all of them to coexist and work because of the segmentation of the customer and the preferences and the process that we all follow to deliver the products.
Thanks. That's a great and very, very comprehensive answer. Thank you. I'll drop off and let others ask questions now.
Thank you.
Thank you. The next question is from the line of Farida Kambata from Kartika. Please go ahead.
Thank you for an excellent presentation. 2 questions. One, could you touch upon your thinking regarding the liability franchise, CASA, and how you see yourself positioning for that? And the second is, as you go more towards the retail space, even though you are accessing the better segment in that market, how do you see this playing out, all taking provisions and everything into account for net interest margins going forward?
Okay, yeah. First is the liability franchise, right? In terms of, if you think about the 5 pillars of strategy that we talked about, and I'll recap them in 30 seconds. The branch strategy, right? Reinvigorating the branch channel. The VRM strategy, virtual relationship management. The digital 2.0. The payment strategy that we talked about in terms of how the merchant ecosystem and the payment process, right? And then the last is the semi-urban and rural. So if you think about these 5 pillars of our strategy, all of these 5 pillars hinges on one top ingredient, that is liabilities. All of them bring liabilities. As much as like an oxymoron, payment, also liabilities, absolutely. Payment also is liability-driven strategy. Why? Because that is where we bring in the customers to open up their current accounts, savings accounts, family accounts, everything. So all of them is that one. That's one. Then the other thing is in terms of how does it make a difference, right? What is the differentiation that happens? which is what we have seen that in terms of implementing the kind of a standardized narrative through a central marketing approach, which is not new. As part of this 5-point strategy that got implemented 2.5 years ago, and right now we are into a great deal of an experience that we have gathered, and we are rolling those things out, which is a standardized narrative. So it is put in front of an RM. RM in the olden days have to figure out what they have to go and talk to a customer in the form of when they have the customer touch point, when they have a relationship discussion, what is it? They have to make up their own mind. But now they do not need to. A standardized analytical based approach gives them standardized narratives. If there are two customers, identical in profile, identical in balances, identical in behavior, they will get the same kind, and two different RMs, they will get the same kind of narrative, same kind of an approach. So we try to standardize as much as possible. So moved away from people dependent to process. So that means analytical driven, pushed through our CRM platform into our RM's hand so that they are able to have intelligent conversations, right? And also through the analytics, it will tell the customer that this RM is completely enriched in terms of the transactions that are happening in the customer's account. Absolutely enriched. That is what the CRM through the analytical process will put it out for this RM to take it and have a discussion with the customer. So we enrich that. In order to use this, we need to have training, which is what we have invested heavily over the last couple of years in terms of training people how to access this, how to use this, and how to deliver this, right? So that training also is part of that ecosystem in terms of the branch, reinvigorating the branch channel process that we did. Then the VRM channel is, we can't practically have this kind of a RM-based relationship management for all the 60 million customers that we have. We cannot. A pretty expensive proposition to do. But we have noticed that where there is a relationship manager assigned to a particular customer, the kind of volumes that come in, the kind of an engagement that it gives to the business for us is enormous, 10 times, 20 times more kind of, depending on the region, depending on the customer and the segment and so on. So we said that was part of the virtual relationship management we brought out. And at this moment, we have a little more than 6 million customers. We want to ramp it up to 10 million and 20 million. And we are driving it also through analytics and some technology too, in terms of how even today, working from home and VRM is being pushed. Pushed means the information is being pushed to the mobile phones of the VRM so that they can have an intelligent conversation sitting at home to the customer. So that's the differentiation we are trying to make in terms of the relationship from that sense on the liability, and across all of the other kind of a semi-urban and rural is nothing but an extension of the branch and the VRM. The payment I just alluded to in terms of how we bring in the liability strategy. So that is how we think about the liability strategy or the branch and the relationship management approach to all of these. Right. Then in terms of your other question was relating to, remind me again? NIM, the net interest margin.
The net interest margin as you go towards more retail.
Yes. See, as a bank, we have operated the net interest margin, if you think about the last 1 year, 3 years, or 5 years, or 10 years, right? Depending on the time period that you choose, you will be able to see we operated between 4.1 on that low end and 4.4, 4.5 on the high end. That's the band at which we have operated. That's part of the ALCO strategy, and that is part of the 2 times a month we run ALCO. And the pricing, both the deposit pricing and the asset pricing are part of the ALCO discussions, and that's how it is determined, how we price products, right? And so this is the range at which we operate, and we have demonstrated that's how we will do. And in order to fix an asset pricing, the cost of funds is an important ingredient, and at what rate and at what quantity can we raise funds. And then at that, if we raise there, at what kind of markup do we need to maintain our NIM? That's how we price the assets, right? And what doesn't meet our threshold, we let the product go. We don't need volumes compromising on anything else. And that's how we try to maintain our net interest margin. While we don't give a particular outlook to say this is where we will land, that's why I gave the historical context to see, if you look at our historical context, 4.1, 4.4, That kind of range is what we have operated historically, and that's where we expect to operate going forward.
Thank you very much.
Thank you.
Welcome.
The next question is from the line of Emil Walter from Comgest SA. Please go ahead.
Afternoon. Thanks for the call. A couple of quick follow-ons to the very informative and kind of details and answers you already given. I think you highlighted quite clearly why the recovery is faster and also why you've been differentiated in this recovery. I guess the natural follow-on to that is to just understand where you are on provisioning and to understand whether or not you expect, based on what you're seeing at this point, which is still quite early, with regards to potential write-backs or changes to the levels of provisioning that might be appropriate. The second thing is just to address a little bit the balance sheet side. I mean, you ended up doing a capital raising or some dilution, new issuance anyway, at a relatively depressed share price. Obviously, circumstances have changed and things have panned out better. But anyway, the cross current of these various things, what do they tell you with regards to the growth that you are realistically sort of going to target for the next 3 or 4 years?
Okay. First, in terms of the provisioning. See, the context of the provisioning is that you need to go back and look at last 4 quarters or 6 quarters, for that matter. Not just the COVID time period. If you look at it, you will see that we have been trying to build reserves to make the balance sheet more resilient. And we have always said that when people have asked, you're building reserves, what for, right? What is the reason for this building reserves are you seeing? We said it is not for any anticipated event or anticipated kind of position. This is more making the balance sheet more resilient and to the extent that it is possible, we want to build reserves. That's, if you go back to our June last year, September last year, December last year, these are all pre-COVID I'm talking about, we built reserves, right? And during this time period, the March quarter, the June quarter, and the September quarter now, also we built reserves, right? So we have been quite conservative in terms of building the reserves where the opportunities exist and making the balance sheet more resilient so that even if, as we call it, a kind of a truck were to come and ram, are you still protected? Are you still having a great deal of a resiliency from a balance sheet point of view? Absolutely. That's the reason that we keep building. When there is an opportunity, we build and keep going. Also in this context, if you see, when we build reserves, it is not that our returns have fallen off, right? We have had good returns, 1.92% type of ROA is what we have had. If you look at all the time periods, including the recent 3-quarter time periods where we build reserves. So it is just that we build reserves in order to keep the balance sheet strong and resilient to be protected. In terms of how we utilize it and how we will release it or reverse it, it is not about, and the purpose of building the reserves is to make the balance sheet more resilient, and to the extent that we need to keep it, continuously keep it more resilient, it will be. And if there is an opportunity to build, we will build, right? And if there is not necessary, it is not necessary. But then we have to take it as the time comes in terms of whether we need to release it or what we need to do. But that's not something that is a quick kind of a call to say, okay, now release it or whatever. So there is a process to follow. We build it for resiliency, and we will watch and make a decision at an appropriate time as it comes through. In terms of the reserving. And your second one was relating to?
It was more related to your to your capital, but just to clarify this point, so I think I understand quite clearly you're not going to reverse or release any provisions, but since the recovery seems to be more confirmed and happening faster, are you going to moderate the level of provisioning, or are you going to still build? This I wasn't clear on.
I will not talk about future what we will do. I never said that we will not release. All I said is that we'll have to evaluate as we go along.
This point.
And correct, exactly, correct. As we have to evaluate and we have to take it as things comes by. And in terms of building of reserves, as a matter of policy in the bank, we do not give any outlooks of what we will do. And where there is more resiliency required in the balance sheet, we will build them. And where it is not required, we will not build, or if we need to release, we will. But one thing is that we will continue with our historical approach of being conservative in our provisioning and our reserving policies. So that is the kind of overarching principle that you need to go away with. Has the bank been in terms of being conservative in its approach to doing these things, and there is no change in our approach to how we have dealt with it in the past as we go forward. And in terms of capital,
Okay.
yes. See, again, there are two elements to that capital question. The one, that capital that we raised, and the second one is the growth outlook. The capital we raised was in 2018, and that gave us about 230 basis points or so of capital ratio. Ever since we have internal generation of capital, we have not consumed it. You know that we have grown quite robustly from mid 2018 to now. We've robustly grown, but we have not. The internal generation has outpaced any consumption. So there has been a net generation of capital since then. 140 basis points or so for the year ended March 20, and since then 60-70 basis points we have generated. So almost 200 basis points we have generated capital. Call it north of 400 basis points we are when compared to pre-raising of capital. So we are in a good spot from a capital ratio point of view. That is why we said that it is not in our works right now. We are not considering capital raise. Is something that consistently over the last 3 months, 4 months, when people have asked, we said that's not something that we have considered in recent times. In future, of course, when the appropriate time comes and there is a requirement, we will. But at this moment, there is none, so we didn't, right? And in terms of the growth outlook over the next 3-4 years, it's not something that we don't put out. We don't target a particular growth. So that means internally, it's not that we want to grow 10, 15, 20, 25. There's no such particular target that we put out. It is about the right kind of an opportunity that we go and book in, right? That's what we have done. And I would only urge to look for our historical trajectory of what we have done. And in the context of the macro, that is how we will perform. More than, I'm not willing to put out one particular number or a range of numbers in terms of outlook, because that's not what we have done. But we will guide you to look at our historical track record in the context of the macro, and there is nothing that has changed from a policy and a kind of a thinking point of view or a strategic direction point of view compared to what we have done in the past that we'll do in the future.
Thank you.
Thank you. The next question is from the line of Arjun Vikas from Falcon Edge Capital. Please go ahead.
Hi. Just one last question from my side would be, how do you look at restructuring, going forward in terms of loans, both for yourself and for the industry? And do you think that is something which will cause a problem, maybe not in the near term, but going forward?
Okay. You're talking about this RBI restructuring post the moratorium, right?
Yeah.
Okay. See, at this time, it's been very benign from a restructuring request point of view, right? Which is what you are hearing from various other industry players, and is no different from what we are seeing, that nothing much is on the table worthwhile. And if you ask our credit head, Jimmy Tata, he'll say, I don't even want to say that such a minuscule number, I don't even want to say what the number is. So given that, where we are now undertaking an education program. Because we do want to ensure that the communication is clear to the customers in terms of, hey, this is available for you if you need. That's one thing. The second thing is that we are not willing to give restructuring just like that for anybody who applies. Because if after the application for restructuring is received, we will make an evaluation in terms of, is the customer having a job, is the customer having a cash flow with an ability to repay, or this is a case that it is a clear case of a loss a quarter or 2 or 3 down the road. And if that is the case, we better take the charge now rather than give a restructuring and take it a few quarters later. So we are making those kind of evaluations, but at the same time, we are trying to educate and communicate to ensure that we do receive enough applications for us to make those kind of a determination. And at this time for us, and you are hearing, and I am also reading in the papers, from an industry point of view, it has been very benign and subdued.
All right, thank you.
Thank you. The next question is from the line of Andrew Graham from Martin Currie Investment Management. Please go ahead.
Hi, yeah, sorry, just a follow-on question, if I may, to the question you answered a little moment ago on capital. Just if I follow on from what you were saying then, if you are able to keep your net interest margins in their historic range and have a similar across-cycle credit experience, given your current capital position and the fact you are sitting on some excess, I'm by my reckoning, you could probably grow loans at a sort of low to mid-teens rate for the next few years without needing any kind of capital. Is that reasonable? But if you're growing more in the 20% range within 2 years, you would probably need to raise capital. Is that approximately right?
See, it depends on the mix of the loans, right? Sure. In terms of the ratings. It depends on that too, in terms of how, and one has to take that also into account. And the second thing that also needs to take into account is, as we said, in terms of our ratios, we are far, far higher than the regulatory minimum at this time, right? We are far higher from that sense. So whether 2 years or 3 years, I don't know what time. Then the third thing that you need to keep in mind is, which we have said that too, we have a subsidiary, HDB, and we've been thinking of capital infusion in HDB to the extent their growth demands capital. And there are several ways that capital can be put into the subsidiary, whether the bank puts in the capital or we have some private equity coming in into the subsidiary to augment their capital needs, or we go to the market and we give, we encash part of our holding, thereby we augment our own capital, bank's capital, right? There are several strategies that can be worked out from that sense. So all of these strategies are on the table, and so the bank needs capital. There are several ways the bank can raise capital. Not necessarily only going to the market, but there are other ways also to raise capital.
Okay. Thanks very much. I think I get what you're saying. Okay, thanks.
Thank you. Ladies and gentlemen, we take the last question from the line of Chamsol Yoon from Lazard Asset Management. Please go ahead.
Thank you very much for giving me an opportunity. I think most of my questions are answered already. Just one final one for me. So I appreciate that you alluded to kind of normalization of cost-income ratio to 38 to 39% in the near term, but I also believe that you mentioned that'll come down in the outer years. Can we just talk about the outlook of the absolute cost? Like what will be so the reason why I'm asking is some banks are alluding to, the recent cost reduction, at least part of the recent cost reduction post-COVID is structural, and I just want to understand whether you have basically same stance on that.
No. I wouldn't call the recent cost reduction as structural. There will be some which are structural because work from home model is, we believe, is here to stay. At what rate, at what percentage of work from today, more than 2/3 to 3/4 are work from home. So from that sense, there are certain structural costs that have changed, right? And going forward in some time, once everything opens up and normalized and people are going to office and working, we do believe we do have action plans, and we are working on various other plans to see that at what percentage that we want our people to continue to work from home. And that gives a lot of flexibility, both from attracting the right kind of people, not necessarily only in the main cities, but across the country, and also at the kind of an appropriate cost structure. So different cities have different cost structure. So if we are indifferent to any city because it's work from home, then we can have it at a different cost structure, different quality of labor too. That can be there. So those remains to be seen how we implement them, but those are in the works in terms of the thinking process. But then the more the way to think about the cost to income or the operating efficiency improvement over a period of time is, one is of course the natural scale, right? As you ramp up the scale and you keep the jaws open, which means the rate of growth on expenses is lower than the rate of growth on revenue, that to keep the jaws open, natural efficiency improvement is there. That's one thing which is natural. So to the extent that you don't do. Then of course we'll want to continue. That is why we'll take it up to 38, 39, and over a period of medium term only it will start to come back down, because we do want to continuously make investments both in branches, in people, and in technology. So we are making those investments, and we'll continuously make some of these digital ecosystems that I talked about is a significant investment in technology that is going in. The other kind of structural benefit that will come is, and driven through COVID also partly, and outside of COVID also, that was part of our strategy anyway, is to look at every process and re-engineer the process. See, what we are trying to do is that instead of changing the technology to suit a process, we said this is the technology. What is the process that needs to change to be operating efficiently? So we are looking at every process of the flow charting to see where there are handoffs, where there are assisted processes for customer journeys, how it should be a straight through process. So this kind of re-engineering process is happening to make the transaction seamless and straight through. We believe that would give another kind of benefit in terms of the cost efficiency that will come through. These are the areas I would say that that we are expecting the cost to income to improve. The digital approach, the process re-engineering, the natural scale that is happening, and some of these kind of a code-related structure thoughts of work from home and these kind of things that have come in are aided process to get there.
Understood. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Adarsh Parasrampuria for closing comments.
Yeah, thank you everybody for joining, and thank you Srini and Ajit for taking out time late in the evening, to join us for the call and address investors. Thank you for giving us this opportunity.
Yeah, but it's our pleasure, and we are thankful that there was an opportunity to talk to people. Thank you.
Thank you very much.
Yeah. Bye-bye.
Thank you. Ladies and gentlemen, on behalf of CLSA, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.